Good morning, students. Today we will continue with the topic of mergers and acquisitions. So let us start with the question number 10. Till the previous session, we have covered the basic concepts in the mergers and acquisitions, and we have covered till question number 9. So today, let's start with the question number 10 from the assignment itself that has been uploaded. So it says that Simple Limited and Dimple Limited are planning to merge. The total value of the companies are dependent on the fluctuating business conditions. So what they're trying to say is that, first of all, they're using the term here as total value. Okay. Whatever is the total value of the companies, those are actually dependent on different types of business conditions. The following information is given for, again, the total value. Students, please note here the total value is also defined in the brackets as debt plus equity. So they are saying that total value for the purpose of this question is debt plus equity. Structure of each of the two companies. So they are saying in case of a high growth, which have a 20% probability, Simple Limited's total value is 820 and Dimple Limited total value is 1050 lakhs. Similarly, three scenarios are given. Then they say that what is the current debt of Dimple Limited is 65 lakhs and Simple Limited is 460 lakhs. They have said that definitely debt is something which does not keeps on changing. If you see, in case of a business cycle or different business conditions, the equity value changes, correct? The debt value does not changes. That's why the debt is less risky. So hence they are saying that the debt remains static at 65 and 460 respectively for both the companies. Calculate the expected value of debt and equity separately for the merged entity. Now they are saying that both of them are going to merge. Now just calculate that what is the expected value of the debt and equity for the merged entity. Now, first of all, we need to calculate that what is the debt and equity separately for both the separate companies, correct? Then only we will be able to calculate the merged debt and equity, correct? So, good morning, Shubham. So the solution is, first of all, if we talk about from what is the first company? Simple Limited. So we are going to do the breakup between debt and equity. Okay, students. So what is the breakup between debt and equity? Now, if I say this is high growth, this is medium growth, and this is slow growth. Then what are we going to say is that for Simple Limited, what's the total value? First of all, 820. So I am writing total here, 820, 550 and 410, correct? Now, if we do the debt part here, debt will always remain at 460 for Simple Limited, 460, 460. And now students, if you see here in the third case, slow growth, the value of the entity becomes, the total value becomes 410. So definitely we are not going to say that equity will become negative 50. No, why? Because the equity also have a limited liability. That's why it is called as a company. If there is no limited liability, then it would have been a sole proprietorship, correct? Since it is limited by the liability to the extent of the amount paid on the share capital, hence we cannot assume that equity will be negative. So hence we are saying that in this case, debt only will have to be adjusted. I'm just putting a star here and defining star here as minus 50 in equity is impossible because of limited liability clause, and hence the value of debt stands out to rupees 4110. Correct? This is all in lakhs. So we can say that this is rupees in lakhs. Okay, student. So hence the value of equity comes out to be 820 minus 460 is 360. 550 minus 460 is 90. And this is going to be nil. This is, first of all, we have calculated the split, the proper split between debt and equity for Simple Limited. Now, similarly for Dimple Limited, now what's the total values that are given? 1050, 825, 1050, 825, and the last one is 590. The value of debt that is there is 65 all across. So it is 65, 65, and 65. We can easily put the debt because the total value is higher than the debt. So there is no need to restrict the debt equal to the balancing number. This is debt, this is total, and this is equity. Now, what is the value of equity here? 985, 760, 525. Okay. Now, we have calculated that in three different scenarios, what is the value of the debt and equity is going to be. Correct? As a next step, we need to calculate what is the expected value of debt and equity separately for both the companies. So for Simple Limited, now we are calculation of expected value of debt and equity. Students, please note that wherever the expected value of debt and equity is concerned and we are given the probabilities, that means expected value means what is the best possible value. How are you going to arrive that? Simply by multiplying it with the probability, because probability or the total of the probability is always 1. That means the percentage chance that this much value will happen is given in the probability. Hence, the expected value will multiply with that particular probability. Correct? So first of all, for Simple Limited, high, medium, and slow. And last, we should have total also. Sorry. High, medium, slow, and then in last we have the total as well, because we are going to do the total also. So first of all, for debt, I'm just writing the probability first, and then what is the debt value? 460, 0.60 into 460. And for slow, it is 0.20 multiplied by 410. Students, please note this figure. It should be 410, correct? That we have calculated. Now, if we just multiply and add all of them, it comes as 450. Similarly, for equity, 0.20 multiplied by 360 0.60 multiplied by 90, and the last one will be 0 only, correct? Because became 0. Equity became 0. So 126 is the total. 576 is the total expected value. Expected total value. And expected debt value is 450. Expected equity value is 126. This is for Simple Limited. Similarly, for Dimple Limited, debt is 0.20 multiplied by 65. 0.60 multiplied by 65, 0.20 multiplied by 65, total will all be 65, correct? Similarly, for equity, 0.20 multiplied by 985, 0.60 multiplied by 760, 0.20 multiplied by 525, and the total is 758. So hence the total value becomes 823. This is the total expected value, correct? And as a next step, now we have to calculate for the merged entity. The Simple and Dimple Limited are going to merge. For that merged entity, what is the expected value on debt and expected value on equity? So now, value of merged entity. Equity, Simple Limited and Dimple Limited. What is the expected value on equity for Simple Limited? 126. And it is 758. So the total value becomes as 884. This is just a horizontal summation, that's all. And debt, Simple Limited is 450 and Dimple Limited is 65. Correct? Dimple Limited is 65. 515. So this is what the expected value of debt and equity separately is. This is what the question had asked us to calculate. Okay. Let us go to the next question. Question number 11. Now, this is a very good question, okay, because this will involve 2-3 things. So let's try to attempt this. So question number 11 says, Yes Limited wants to acquire No Limited, and the cash flows of Yes Limited and the merged entity are given as follows. So they are saying that Yes Limited wants to acquire No Limited, and there is a merger that happens, and then after the merger, this is the merged entity cash flows, and before merger, this is the Yes Limited's cash flow. They have given us 5 years cash flow, rupees in lakhs. Then they are saying that earnings would have witnessed 5% constant growth rate without merger. Now they are saying that 5% growth rate if Yes Limited would have continued, and 6% with merger, 6% for the new entity on account of economies of operations after 5 years in each case. So this is after 5 years, correct? So after 5 years, 5% for Yes Limited and 6% for merged entity. The cost of capital is 15%. They are saying that the cost of capital is 15%. The number of shares outstanding in both the companies before the mergers is the same. The total number of shares outstanding is same. And the companies agrees to an exchange ratio of 0.5 shares of Yes Limited for each share of No Limited. So 0.5:1 is the swap ratio that they are saying. They are also given as the present value factors at the rate of 15%, which is fine because we have to use the cost of capital at 15% only. So we will make use of these factors. So first of all, they are asking us to calculate the value of Yes Limited before and after the merger. Simple. So the valuation can be easily calculated. We just have to take the present value of the future cash flows and the terminal value. This all of you would have studied in your valuation topic, correct? So this is very easy. Years 1, 2, 3, 4, 5, and this is another 5 for the terminal value I'm putting. Okay. So cash flows are for Yes Limited. First of all, we are calculating 175, 200, 300. Sorry, it's 320, then 340, then 350. And how are we going to calculate this terminal value? See, so terminal value, what we say is 350 is the year fifth number. So what would be the year sixth number? First of all, 350, 1 plus growth rate. Correct? There is a growth rate, and that we divided it by the total cost of capital minus the growth rate. Correct? That's how we calculate the terminal value. That is already given as a concept in the previous sessions on the valuation. Correct? So what we do is we take the next year cash flow, divided it by the cost of capital minus discount rate. We will get the terminal value for that. Terminal value means that this is actually the perpetual cash flows that we are going to get. So the valuation of the perpetual cash flows will be that perpetual cash flows divided by the 15% minus 5%. Okay, students. So this comes as 3675. Now here we'll note down the present value factor. And please note this perpetual cash flows amount, that is terminal value, will be for the fifth year end. Although we take the cash flow for the sixth year and divided it by the difference between the cost of capital and growth rate, but this formula will give you the present value as at the end of the fifth year, not at the end of the sixth year. Because to calculate the present value at the end of the fifth year, we need the cash flow starting from sixth year. Okay. So hence it is 0.870, 0.756, 0.658, 0.572, 0.497. And for this also we will put 0.497 because this is the fifth year end terminal value. Then what is the present value of cash flows? The present value of cash flows is 175 multiplied by 0.870. This becomes as 152.25, 151.20, 210.56, 194.48, 173.95, and the last one is 1826.475. Correct? This is just a simple multiplication. So the total value comes as 2708.915. Similarly, for the merged entity, cash flow of merged entity is 400, 450, 525, 590, 620, and 7302. Okay. So here it comes as present value of cash flows 348. So I'm just writing how we calculated this 7302 as well. So 620 is the year fifth cash flow, but in this case the growth rate is 6%, correct? Not 5%, because the merger has already happened. So 15% minus 6%, which is divided by the 9% we will do. Okay. So this is arrived from this formula. So 348 and then 340.20, 345.45, 337.48, 308.14 and 3629.20. And the total for this is 5308.47. This is the total value of the merged entity. This is the total value of entity before merging 2708, and after merging it is this much. Now the second part, it is asking us to calculate the value of acquisition. So the value of acquisition simply will be value of acquisition is equal to 5308.47, which is the value of the merged entity minus the value of the entity before merging. Hence, the acquisition value comes out to be 2599.555 lakhs. This is the value of acquisition. Correct? And the last point is saying gain to the shareholders of Yes Limited. Now, first of all, after, let's say, the merger, okay, this is, let's say, the total shareholding. For example, the box represents the total shareholding. The shareholders of Yes Limited represents this shaded box, for example. Correct? This is Yes Limited's shareholders, and this is No Limited's shareholders. Correct? We know that total value is how much? The total value is 5308.47. This is the total value, correct? So they're asking us that before merger, the same value for Yes Limited shareholder was something. Now the total value for Yes and No put together is this much. You tell us how much Yes Limited shareholders are able to gain. That we will be able to tell once we know that within this value, how much does it belongs to Yes Limited. Correct? So for that, we have to calculate a proportion simply. What is that proportion? So percentage shareholding of Yes Limited's shareholders in merged entity. So they have said that both of them have the equal number of shares and the shares are issued as 0.5:1. That means 0.5 belongs to No Limited, 1 belongs to Yes Limited. So we can say that 1 divided by 1 plus 0.50, which comes out to 0.67 percentage. Correct? This is the proportion. That means the percentage, so the value of Yes Limited's shareholding is equal to 5308.47 multiplying it by the 0.67. Oh, sorry, this is 67 percentage. This is my bad. 67 percentage. If we do not 0.67, so if we do 1 divided by 1.5, 66.67 roughly I can put 66.67 percentage. Similarly, this also 66.67 percentage. Okay. So this comes as 3538.98. From this, we will reduce the existing Yes Limited value. Existing means pre-merger. So the pre-merger value Yes Limited is how much? 2708.95 that we have already calculated in the first step. So that means the gain to shareholders for Yes Limited comes out to be 830.065. Okay, so this is the pre-merger value that is coming out to be. And hence this is the gain. Sorry. 830.065 is the gain that will accrue to the Yes Limited shareholder because of the merger. Okay, students. So let's move on to the next question because we have a lot of questions to cover today. Please ask any queries, students, that you might face. Question number 12. The following information is provided relating to the acquiring company Efficient Limited and the target company Healthy Limited. Now they're saying that the company who's acquiring is Efficient and the target company is the Healthy Limited. Number of shares that they have given, market cap they have given, P ratio, reserves and surplus, promoters holding. They have given promoters holding and the total shares also. Correct. Now, what does the board of directors say? Board of directors of both the companies have decided to give a fair deal to the shareholders, and accordingly, for a swap ratio, the weights are decided 40, 25, and 35% respectively for earnings, book value, and market price of share of each company. So they are saying that the earnings per share, book value per share, and market price per share, they will use all the three swap ratios and use this proportion to arrive at a fair deal. So the first part they are saying that they calculate the swap ratio and also calculate the promoters holding percentage after acquisition. So it is very simple. It is just calculation extensive question, but it's very easy because all the data is given. So first of all, for Efficient Limited and Healthy Limited, correct? Let's put the data in a structured manner. So first of all, the market cap is given. See, students, we have to calculate EPS, MPS, and book value per share. All the three things first to calculate the swap ratio, correct? So we will calculate all these three things. Some of them are given and some of them we have to see. Market cap 500 lakhs. And this is Healthy 750 lakhs. Number of shares. 10 lakhs. 7.5 lakhs. MPS, which is the market price per share, will be simply market cap divided by the number of shares, correct? So this becomes 50 and this becomes 100, which is 750 divided by 7.5, correct? MPS is calculated. Now we are also given what is the PE ratio. PE ratio is also given, correct? 10 and 5. 10 and 5. Profits are given as how much? Profits are not given. Now what we can do is let's first calculate the EPS, not profits, but EPS, because we have the MPS, we have the PE ratio. Can we calculate the EPS? Yes. EPS is what? EPS will be equal to MPS divided by the PE ratio. So this becomes 50 by 10, 5, 100 by 5, 20. This is the EPS. Then profits. Profits will be simply EPS multiplying with the total number of shares. So 5 into 10 becomes 50. 20 into 2.5 becomes 150. These are the total profits that they are earning. Now, what's the share capital? Share capital we can easily calculate because the number of shares and the face value of the shares is given. So it becomes as 100 lakhs and it becomes as 75 lakhs. Reserves and surplus. Reserves and surplus becomes how much? This is also given 165. 165 lakhs. Hence, the book value per share will be, the total book value is how much? First of all, the total book value is how much? 100 plus 300, 400. 75 plus 165 is 240. Correct? 170, 240, yeah. Then book value per share. We just need to simply divide it by the number of shares, correct? Which is 40 and 32. So now we have calculated book value per share, EPS and MPS, all of them using the data that is given in the question. Now, swap ratio can be calculated by all these three methods. First of all, earnings. So what is the ratio? What is the formula for swap ratio? The formula for swap ratio is the target company EPS divided by the acquiring company EPS. So 20 by 5, correct? 20 divided by 5. Then B is actually the book value. Book value is 32 by 40. And C is the MPS. MPS basis it is 100 divided by 50. Correct? So this becomes as 4:1, 0.8:1, and this becomes as 2:1. And the weights are also given in the question, which is 40%, 25%, and 35%. So this becomes as 1.6, 0.2, and 0.7. The total is 2.5. This is the total value. So that means the swap ratio is 2.5:1 basis the above criteria. Whatever is the criteria given to us in the question, we have applied that criteria and we have found that the overall swap ratio comes out to be 2.5:1. Okay. You can note it down, but then we'll move to the next part. So till now we have calculated the swap ratio. Okay, students. Yeah. Then coming to in the first part only, they are asking us also to calculate the promoter's holding. What is going to be the promoter's holding after acquisition? So we have to first calculate the total number of shares and the promoter's number of shares. So B part. So for the first part only, we are doing the B part. Promoters holding. Correct. So first of all, the promoters shares will be how much? 4.75 lakhs plus, because 4.75 is actually given in the question for Efficient Limited, they are already having. And the 2.5 times of the swap ratio, because 2.5 we have to multiply in 5 lakhs. 5 lakhs is already the promoters holding in Healthy Limited. Correct. So those also will be coming as a promoter here only. Correct. So this becomes a total of 17.25 lakhs. Similarly, total number of shares will be how much? 10 lakhs is for the acquiring company and 2.5 is the swap ratio. 7.5 lakhs is the total for the other company. So this brings the total as 28.75 lakhs. Simple. Hence, the promoters holding comes out to be 17.25 divided by 28.75 lakhs. Correct. This is what the promoter holding is, which is actually 60%. Correct, students. So We have first calculated this is the swap ratio. What is the promoters shares? What are the total number of promoter shares? And second is what is the what would be the total number of shares going to be? Correct. Using that, we have calculated this ratio. Now, let's go to the second part. What is the EPS of Efficient Limited after acquisition of Healthy Limited? Very easy. We have to just calculate the EPS of the new company. So for calculating the EPS, what is the earnings after tax for both the companies put together? 50 and 150 that we have already seen and calculated here. The profits is 50 and 150, correct? And just now we have calculated the total number of shares, 28.75. All of them are in lakhs. So it becomes as 6.956 per share. This is the EPS. Then what is the expected market price per share and the market cap of Efficient Limited after acquisition, assuming P ratio of the firm remains unchanged? So they are saying now apply the same PE ratio and calculate the market price per share and the market cap. MPS will be calculated as 6.956 multiplied by the PE ratio, because EPS we are going to use the new EPS, and question has already said to take the same PE ratio. So same PE ratio is 10. So which brings this as 69.56 per share. This is MPS, and the market cap 69.56 multiplied by what is the total number of shares. Total number of shares is 28.75 after issuing, correct? So this comes as 1,998.5 lakhs. Yeah, 1,999.85 lakhs. Okay. Now, the last part of the question. Calculate the free float market cap of the merged firm. Students, please note, we have already covered the formula of free float market cap. So for the new company, free float percentage is how much? 1 minus promoters percentage, correct? Which is actually equal to 1 minus 60%, which we can say it is 40%. So the free float percentage of holding is 40%. So that if you're going to take the total value 1,999.85 lakhs into 40%, then it will give us the free float percentage, which is 799.94 lakhs. This is the free float market capitalization. Correct, students? Because free float is what is other than promoters. That is called as free float. So along with this, we have completed this question. Very easy, very simple question. It just asked us, given the certain data points, to calculate the different points. Now let us go to the question number 13. Again, a similar type of question, but there is some new twist in this question. That's why I have added this question. So let's see this. The following information relating to the acquiring company Abhiman and the target company Abhishek. Okay. Both the companies are promoted by a multinational company, Trident Limited. The promoters holding is 50 and 60% in both the companies, respectively. They have given us that what is the promoters holding in respective companies. So they are saying that the share capital, free reserves, paid up value also they have given. Paid up value will be used to calculate the number of shares. Then they have in this given the free float market capitalization. They have not given us the total capitalization, total market cap. They have given us the free float market cap, and they have given us the promoters holding percentage. Can we calculate the total market cap and the market price per share using this? Yes. Correct. We'll see how. P ratio is also given. Now it is saying that the Trident Limited is interested to do justice to the shareholders of both the companies. For the swap ratio, the weights are assigned to the different parameters by the board of directors as follows. Now, in this also, they are saying that they will go through these three methods. One is the earnings per share, one is the book value per share, and last one is the market price per share. What is the swap ratio based on the above weights? They are asking us to calculate the swap ratio. First of all. Okay. Now, the similar type of data we will have to prepare. The way we did it in the previous question, in this question also, we have to put all the data points together. For calculating the swap ratio, we first need to calculate what is the MPS, what is the EPS, what is the book value per share, correct? So let's calculate that. First of all, let's make use of the data that is given. Share capital is given as how much? 200 lakhs and 100 lakhs. Free reserves are given as 800 lakhs and 500 lakhs. So the total comes as 1000 lakhs and 600 lakhs. 1000 and 600, correct? Hence, the number of shares will be share capital divided by the paid up value per share. So 200 divided by 100. Two lakh number of shares, correct? Similarly, here also 100 lakhs divided by 10. So this becomes 10 lakhs number of shares. Can we calculate the book value per share? Book value per share comes out to be 1000 divided by 2, which is 500 rupees per share. Similarly, 600 divided by 10. So it becomes 60 per share. This is the book value per share. Now, the promoters holding. Now let us go to the market price per share, correct? Promoters holding we are given as 50% and 60% respectively, correct? In both the companies. So that means the non-promoters holding will be how much? 50 and 40, correct? If 60 is the promoters holding, then non-promoter holding will be how much? 40%. Then free float market cap is how much? 400 and 128. Correct, student? So 400 and 128 is the free float market cap. So can we say that what is the total market cap? Yes. We will just have to divide this by 50%. Correct? And similarly, 128 divided by 40%. So this comes as 800 lakhs. And this is 128 divided by 40% comes as 320. Yeah. Okay, so this is the total market cap. can we using this and the number of shares, can we calculate the MPS now? Yes. So 800 lakhs divided by what is the number of shares? 2 lakhs. So the MPS comes as 400. And similarly here, it will be 320 lakhs divided by the number of shares is 10 lakhs. Correct? So 320 divided by 10 becomes 32 rupees as the market price here. Correct? Then comes the P ratio. So we have the EPS here. Where is the EPS? EPS. No, EPS is not there. EPS is what we have to calculate now. P ratio is given here, 10 and 4. Correct? So we have the MPS and PE ratio. Can we calculate the EPS? Yes. 10 and 4 is the PE ratio. The EPS will be how much? 400 divided by 10, which is 40. And here it will be 32 divided by 4, which is 8. Correct. So the EPS is also calculated 40 and 8, and hence the total profits total I'm saying, that will be 40 multiplied by the number of shares. Number of shares are how much? 2 lakhs. So 40 into 2 lakhs is 80 lakhs. And similarly, 8 into 10 lakhs. Correct? 10 lakhs is the number of shares here. It becomes 80 lakhs. So the basic calculation is done. We have calculated the EPS, MPS, and the book value per share. Okay, students. So this is done. Now we have to calculate the swap ratio. Calculation of swap ratio. So the swap ratio, first of all, we will take the book value. Again, target company value divided by the acquiring company value. Same principle. 60 divided by 500, and we will multiply this with the weights also. So this becomes as 0.03. EPS 8 by 40. This 8 divided by 40. Correct? Multiplied by the weight is 0.50. Hence the total is 0.10. Then the next part is the market price. (32 by 400) into 0.25. So this comes as 0.02. The total comes as 0.15. So hence the swap ratio (0.15 is to 1). Till now we have calculated the first part of the question. Now see students, what the second part is saying. What is the book value, EPS, and expected market price? Now it is asking us to calculate all the three things again: book value per share, EPS per share, market price per share, after the acquisition of Abhishek Limited, assuming P ratio remains unchanged and all assets and liabilities are taken over at the book value. Perfect. We don't have any problem in this. We have calculated for the individual ones. Now we have to calculate the consolidated one. So now the B part. Okay. Book value. So first of all, we have to calculate what are the total number of shares. We will add the existing shares, which is 2 lakhs plus 0.15 multiplied by 10 lakhs. This is the swap ratio. These are the existing shareholders of the target company. So this in totality will become how much? Is equal to 3.5 lakhs. This is the these are the total number of shares that are there. Now book value. What are the different book values of both of them? 1000 and 600, correct? So this will be total book value. This whole divided by 3.5 lakhs. I'm writing this as book value per share. Okay. This comes as how much? 457.14 per share. Then comes EPS. EPS, we have the total profits 80 lakhs plus 80 lakhs that we have calculated. This whole divided by 3.5 lakhs number of shares, correct? So this comes as 45.71 per share. This is the EPS, correct? The market price will be calculated using the PE ratio. 45.71 multiplied by the same PE ratio of 10, correct? Because they are saying that the PE ratio remains unchanged. 457.10 per share. Simple. So the second part is also done. Now the third part, it is saying calculate the promoter's revised holding in Abhiman Limited. Now the C first part, the C part 1, sub part 1 says that the promoter's holding in the new company. Promoter's holding. The existing company, it was how much? Abhiman? It was 50% on 2 lakh number of shares. So this will become as 1 lakh. And Abhishek Limited, it was 60% on 10 lakh shares with a swap ratio of 0.15. Correct? So 10 lakhs is the total number of shares of Abhishek Limited. In that 60% belongs to the promoters. Now, once that gets merged into the new entity, there is a swap ratio of 0.15 that is applied to the shares of Abhishek. Hence, the number come out to be 0.90 lakhs. So the total is 1.90 lakhs. Total promoters shares and percentage holding comes out to be 1.90 lakhs divided by 3.5 lakhs, which is actually 54.29%. This is the promoters shares. Okay, students. So this is the promoters holding. Very simple again. We have just applied the simple thing. Now, next part. They are asking us to calculate the free float market capitalization. That also is very easy. The free float market capitalization, C part, second subpart. First of all, we need to calculate what is the total market cap. The total market cap is 3.5 are the total, 3.5 lakh is the total number of shares. Just now we have calculated the market price per share, which is 457.10, correct? Hence that total comes out to be 1599.85 lakhs, right? This is the total market cap, number of shares multiplied by the market price per share. Now, out of this, what is the free float? Market cap 1599.85 lakhs multiplied by 1 minus promoter holding, which is 54.929 percentage. Correct? Okay. 1599.851 multiplied by 1 minus promoters holding, which comes as free float market cap is equal to 731.36 lakhs. Correct? So till now, there is no rocket science in the question. Till now, it is very easy, very simple. But now comes the part for which I wanted to discuss this question. Now, it is saying that also calculate the number of shares, earnings per share, and book value if after acquisition of Abhishek and Abhiman Limited decides to, if after acquisition of Abhishek Limited, comma, Abhiman Limited decides to, what he is deciding to do is two things. One is that first Abhiman Limited will issue bonus shares in the ratio of 1:2. Now, students, all of you tell me, if the bonus shares are issued, does it makes a difference to the overall capital of the company, or only it impacts the number of shares? So the bonus shares, this only impacts the number of shares, correct? Because your total capital still remains total capital. What you're going to do is, while issuing the bonus shares, you're just transferring the reserves and surplus or some kind of a provision or some kind of a reserve and surplus to the share capital. Simple. Accounting wise, correct? The total capital remains same, but the number of shares increases. That's what we do in bonus shares. And the second they are saying is the split the stock share as ₹5 each fully paid. Currently, what is the share capital? 200 lakhs and the paid up value is 100. Correct? That means for 101 share, they're asking us to split into the 555 rupees each share. Correct? If we split into 5 rupees per each share, that means 20 such share will be equal to 1 share today. Correct? Because 5 into 20 is equal to 100. Correct? That means what simply it is asking us to do is to split the current share into 20 shares. Simple. I hope all of you are getting my point. Then only the 100 rupees fully paid up share will become 5 rupees paid up share. If we split the current share into 20 number of shares. So very simple. They are saying that whatever is their total number of shares, you first of all increase them by the number of bonus shares. Now, once you increase them by the number of bonus shares, then split them into the 20 rupees each share by having it 5 rupees each fully paid up. Correct? That means divide 1 share into the 20 different shares of ₹5 each. So we will see the calculation here. Now the C third part, 1:2 bonus shares So the total number of shares before merger, sorry, before bonus. This is after merger, but before bonus is how much? 5.25 lakhs. I'm sorry, it's 3.5 lakhs, correct? See, 3.5, 3.5. This is what we have calculated. Now, 3.5 lakhs number of shares will be increased by 1:2 bonus shares. So the bonus shares in the ratio 1:2 will be 3.5 into 1 divided by 2, correct? Which is 1.75 lakhs, correct? This is the bonus shares that we are going to add. Hence, the total shares is going to be 5.25 lakhs. These are the total shares. Number of shares of total shares after bonus, but before split. Now, in the next step, they are going to do the share split. How they are going to do the share split? So the number of shares after share split, 5.25 lakhs into 20, correct? Because whatever is the existing number of shares, they will multiply it into 20 to arrive at the 5 rupees each fully paid kind of a share. This becomes 105 lakhs. So now the total number of shares that we have is 105 lakhs with a 5 rupees each fully paid up share capital. And hence, now the EPS and the book value, the total earnings and the total book value will remain same only, correct? Because as I told that, what does this, these two actions have an impact. Bonus shares and stock splitting will never change your total capital. It will only change your number of shares in the capital. Correct? I think all of you agree with me. Because the bonus also, it just means moving some amount from reserves and surplus to the share capital. And the splitting the stock means within the share capital, if there are 10 shares, now instead of 10 shares, there are 15 shares for the same value. We are increasing the number of shares. We are reducing the denomination from 100 to 5. Correct? So what is EPS now? Again, 80 lakhs plus 80 lakhs divided by 105 lakhs. So the EPS comes out to be 1.523. And the book value comes out to be 1600 divided by 105 lakhs, both in lakhs. It comes as 15.238 per share. Correct? Now, students, if you see and compare this with the earlier EPS and the earlier book value per share, there is a drastic difference. The earlier book value per share used to be 457 rupees and the EPS used to be 45 rupees. But now, after the split, the EPS and the book value has dropped. Why? Because the number of shares have increased. Simple. The total numerator is still the same, which is the total earnings and the total book value still is the same. But since the numbers have increased, hence the per share value has been dropped. Okay, students. So this is what the question has asked us to calculate. Today, no questions from anyone. Students, again, I'm saying, please ask any questions that you are facing in terms of any difficulty. That will help me also to gauge whether I'm bringing the concepts in a proper manner or not. Okay. So please do ask any questions that you have. Okay. So we'll move on to the next question now. Question number 14. Yes. So question number 14 says, T Limited and E Limited are in the same industry. Okay, both of them are in the same industry. The former, which is T Limited, is in negotiation for acquisition of the later. So that means T Limited is in talks to acquire E Limited. Important information about the two companies as per their latest financial statements is given below. Okay. What are those? Rupees 10 equity shares outstanding is 12 lakhs and 6 lakhs. Correct, students? So they have given us that what is the rupee 10 equity share outstanding. Number of shares are also given through this information, and the total share capital is also given through this part of the information. Correct. Now, the next part they are saying is what is debt? Debt 10% debentures is 580 and 12.5% institutional loan is 240. Okay. Hence, the next comes as earnings before interest, depreciation, and tax 400 and 115.71. This is called as EBITDA. And they have given us the market price per share 220 and 110. Now, T Limited plans to offer a price for E Limited, okay, business as a whole, which will be 7 times of EBITDA reduced by the outstanding debt. Now, see students, there are two thought process here. One is from T Limited standpoint and second one is from the E Limited. Correct. So if we say from T Limited standpoint, they are saying we will just do the 7 times of EBITDA and reduce the debt of yours, and we will arrive at a valuation here, which we will be paying you as a purchase consideration in the form of own equity shares. Correct? That's what it is asking us. And the own equity shares will be issued at a market price of 220, that is given above. Now, what does E Limited is saying on the other hand? Now, E Limited is planning to seek 1 share in T Limited. Now, E Limited is saying that, okay, I will take 1 share in T Limited for every 2 share in E Limited. So, E Limited on the other hand is saying, no, we will not go to that model. We will prefer that you issue us your 1 share against the 2 shares that we have. That means the swap ratio that they are saying is 1:2 or 0.5:1. And this is again, we are saying that this will be all based on the market price. How they have calculated 1:2 is, if you see the price also, it is of the same indication. 110 by 220 is 1:2. Correct? Tax rates for the two companies may be assumed to be 30%. So they are saying you assume the tax rate to be 30%. Calculate and show under both the alternatives. So they are saying there are now two alternatives. One is if we go ahead as per T Limited, and second one if we go ahead as per E Limited. So they are saying under both the alternatives, you have to calculate the total net consideration payable, number of shares, EPS, expected market price, and the advantages also it is asking us to calculate. Okay, students. So let's go one by one. First, we will follow the T Limited's offer. As per T Limited's offer, A part is the net consideration payable that we have to calculate, right? What is this net consideration payable? 7 times of EBITDA, 7 times multiplied by 115.71 lakhs, 809.97, correct? Less debt. Debt of how much? 240, correct? That is the debt of 240, which is 12.5% institutional loan of rupees 6 lakhs. Of rupees lakhs is 240 lakhs, right? This is the total value as per the T Limited's offer currently. Correct. So 7 times simple. We have gone by the formula 7 times of the debt. Sorry, 7 times of the EBITDA less debt. Now number of shares. So the number of shares will be issued on the T Limited's market price. So which is 569.97 divided by the T Limited's market price is how much? 220. This is all in lakhs. So this becomes the total number of shares becomes 2,59,077. These are the total number of equity shares issued by the T Limited to the shareholders of E Limited. Correct? Now, the next part it is asking us to calculate the EPS of T Limited after acquisition. EPS of T Limited after acquisition. So first of all, we have to calculate that what is the total earnings attributable to the equity shareholders. Correct? So we are given in the question the total EBITDA, correct? Earnings before interest, depreciation, and taxes. DAT is actually 400 plus 115. Correct? So this comes as 516.57 lakhs. Less interest. Interest is how much? 58 plus 30. How we have calculated this interest? So on 580, there is a 10% interest, and on 240, there is a 12.5%. 240 multiplied by 12.5%, and 580 multiplied by 10%. All this put together is the interest, correct? For both the companies. So this comes as 88 lakhs. So earnings before interest, depreciation, and tax. Sorry, this is after interest, no? Now, students, if you see in the question, there is no information on depreciation, right? So we will ignore it. So we will just simply say that this is the earnings before tax. Correct? 428.57 lakhs. Correct? Less 30% tax. So 30% on 428.57 lakhs comes out to how much? 128.57 lakhs. Total earnings becomes 300 lakhs. Total number of shares. So for calculating the EPS, we have calculated the earnings. Now we are calculating the total number of shares, which is 12 lakhs plus 259,077. Correct? 259,077 and 12 lakhs. 12 lakhs is the existing number of shares, and this is what they are going to issue. That means 1459,077 is going to be their total number of shares, and hence the EPS is going to be 20.56 per share. Simple. This is the EPS that is going to be. And then they're asking us to calculate the market price per share of T Limited. For that, we would need the PE ratio. See, we already have calculated the EPS. If we have the PE ratio, we can easily calculate the market price by multiplying the PE ratio, assuming it to be the same. So the last part, fourth part, expected market price. Now for calculating the existing PE ratio, we need two things. What is the existing EPS and what is the existing MPS? Now the existing MPS is already given in the question, right? Existing MPS is 220. But the existing EPS is what we have to calculate. So again, we will start with the data on T Limited. So EBI DTA only for T Limited is how much? 400.86 lakhs. In this, we will reduce the interest 580 into 10 percentage. This comes as 58 lakhs. The net amount comes as 342.86 lakhs. This is called as profit before tax. PBT. Less tax we will do. %30 on 342.86. This comes as 102.86 lakhs. Correct? And if we reduce this, the earnings after tax becomes 240. Correct? So the earnings after tax becomes 240 lakhs. Now the number of shares that T Limited is having is 12 lakhs. EPS is how much? 240 divided by 12, which is 20 rupees per share, correct? 20 rupees per share becomes the EPS. Now, the PE ratio, because our objective was to calculate the PE ratio, existing PE ratio, correct? So the market price is 220 divided by 20, hence the PE ratio is 11 times. The PE ratio is 11 times, and hence the revised expected market price, basically, we can say, (11) multiplied by what is the EPS of the combined entity, 20.56. So which becomes 226.16. So this is the expected market price. So students, please note that first of all, in this part of the question, we have calculated what is the existing PE ratio. The existing PE ratio, for that to calculate, we know that what is the MPS per share, market price per share, but we don't know that what is the EPS. Hence, we have calculated the EPS because all the relevant information for calculating the EPS was given. That means the total number of shares, the total earnings, everything. And hence, we have calculated the expected market price. So these are all the calculation as per the T Limited's offer, which is the acquiring company. Now we have to see that what are the terms and conditions as per the E Limited's offer, correct? As per E Limited's offer. First of all, what was the E Limited's offer? Can we just go and see it again in the question? The E Limited is planning to seek one share in every two shares. That's all. They have directly given us the 1:2 swap ratio. Simple. And that too, they are saying that it is evident in the market prices also. If you see 110 divided by 220, you will get 1:2 only. Correct? So we will say that what is the net consideration payable? It is going to be 6 lakhs multiplied by 110. How we have calculated the 6 lakhs? Or there is another way to look at, okay, I'll tell you. Let us ignore this 6 lakhs into 100 by 10, correct? See, what are the total number of shares of E Limited? E Limited's shares is 6 lakhs, correct? So swap ratio is how much? 1:2. Hence the E Limited's shares to be issued is equal to 3 lakhs, correct? To be issued by T Limited. So T Limited will issue 3 lakh shares, and the market price of this 3 lakhs to be issued will be 220. So this is from the perspective of T Limited, correct? So that means The total amount of consideration agreed is 660 lakhs rupees lakhs. Okay, students. Why I've done this is I have just gone step by step. So current E Limited's number of shares are 6 lakhs. As per the swap ratio, the number of shares to be issued by T Limited to the shareholders of E Limited is 3 lakhs, and those shares will be issued at the current market price of T Limited, which is 220, and hence the total amount payable is 660. Now, if you see as per the T Limited's offer, what is the total amount coming to be? 569.97, which is slightly lesser. Correct? Hence, E Limited will prefer this option because this is fetching them higher net consideration compared to the first option. Correct? So E Limited will prefer second option, T Limited will prefer their first option, which they have already said in the question also. Correct? Now, the number of shares to be issued that we have already calculated. Number of shares to be issued are how much? 660 divided by 220. 660 lakhs divided by 220 is the current market price. That means the 3 lakhs number of shares are to be issued. Then comes the EPS after acquisition. So for this, we have to take the earnings after tax divided by the number of shares. What is the earnings after tax? In the T Limited's calculation, we have calculated the total earnings, which is 300 lakhs, correct? So if I put 300 lakhs here and the total number of shares, 12 lakhs plus 3 lakhs. 3 lakhs is the new issue and 12 lakhs is the existing shares. This comes as 300 lakhs divided by 15 lakhs, which is equal to 20 per share. EPS is equal to 20 per share. This is the EPS after acquisition. From E Limited's point of view offer. And the fourth part is expected market price. What is the expected market price? We will use the EPS of 20 multiplied by the PE ratio that we have already calculated in the previous steps of calculation, which is this 11 times. We can make use of those numbers only here. So it will be 220 per share. Now, students, if you see and analyze the impact basis the T Limited's offer and the E Limited's offer, E Limited is actually asking for a higher consideration, and the EPS and the MPS is 20 and 220 compared to the MPS of 226 and EPS of 20.56. So definitely, as per the E Limited's offer, E Limited is trying to get more money, and hence the combined entities EPS and MPS is going for a reduction as per the E Limited's offer, which is 20 and 220 compared to 20.56 and 225.6. Okay, students. Now, this is all the calculations part. Now, the last part, which this question says is, state briefly the advantages to the T Limited from the acquisition. So this is a theoretical part. Now, what are the advantages? See, some of them we already know because through a lot of questions we have been seeing those things. Okay. Now, what are the advantages? The advantages, first of all, if you see from the flow of question, the EPS and MPS would increase. If you see as per the T Limited's offer, the EPS, see currently T Limited's EPS and MPS is what? EPS is 20 and MPS is 220. It is going to 20.56 and it is going to 226 point something, correct? So both EPS and MPS are increasing if you follow the T Limited's offer. That is the first advantage. Now, theoretically, if you ask me, definitely there will be synergy. There is a synergy advantage that it will have. B part is, since both of them are operating in the same industry. Now the question is started is that they both of them are operating in the same industry. That means after merger and acquisition, T Limited will enjoy higher market share because currently both T Limited and E Limited are part of the same industry. So the better market share will come to T Limited. Correct. Let's say T Limiteds have a market share of 30%. Similarly, E Limited have a market share of 10%. So the combined entity will have a market share of 40%. So definitely it's a better market share. And since both of them are competitors, it will also make sure that there is a avoidance of competition in the industry because E Limited is now taken over by T Limited itself. So there is no competition left in the market. So there will be a synergy. There is a better market share, I can say, better market share and avoidance of competition. And of course, the EPS and MPS is actually increasing as per the T Limited's offer. So these are some of the advantages that we have seen the given facts and we have actually related it to the facts that are given in the question. Yeah. So I think the first question from Namita. Thanks, Namita, for asking. Sir, if competition is wiped out from the market, how will it be beneficial for customers? Definitely, if the competition is wiped out from the market, it will not be beneficial for the end users because in that case, for users or the end users or the customers, it will be mostly that it will be operating like a monopoly, correct? But still, I'm saying that when we talk about market share, correct, it does not mean that only these two companies would be there in the market. Let's say there will be some other companies also in that same type of industry. T Limited, E Limited, A, B, C Limited, correct. But T and E were the market leaders, for example, because they have substantial shares, 30 and 10. Still, other companies are there. Still, after they are getting 40% as the total market share, 60% is still held by some other companies, correct. But at least now the major chunk of the market share, that is 40%, is held by one company. Rest 60% would be held by, let's say, 20 companies, correct. So definitely it is not beneficial for customers when it comes to entire 100% is taken by one company itself, correct. And hence, Namita, you would know that there is an act called, I think, Competition Act, correct, in which there is an authority which makes sure that customers gets a fair this thing. I don't remember the exact name of that act, but it has to do with the competition only. There is a competent authority which will see that if, I think it's called as avoidance on competition, or I don't know, there is something like that in the law examination that is there. So that is to protect the rights of the customers in case there is a 100% consolidation happening. Okay. That has to do with the prevention of consumers' rights and all. Okay. So yeah, that is why from some part it is good and some part it is not good. Yeah. So question number 14 is what we have concluded. Now let us go to the question number 15. Yes. So this is one of the question on demergers, or let's say one company coming out. I mean, one company splitting into two companies. So this is also a very good question. Let us read out the question first. The following information is related to Fortune India Limited having two divisions, this pharma division and fast moving consumer goods division. So they are saying there is a company called Fortune India. It has two divisions, pharma and FMCG. Paid up share capital of Fortune India Limited, which is the now students please don't get confused. Now wherever they will use Fortune India, that means it's a old company, and pharma and FMCG will be the two new companies. We'll read out the question and we'll see. So paid up share capital is consisting of 3,000 lakhs equity share of rupee 1 each. That's okay. Then Fortune India Limited decided to demerge. Pharma division is Fortune Pharma with effect from 31st of April 2009. So if we see this, this is 1st April 09 and let's say 31st March 09, correct? So this is the close and this is the open, correct? So they are saying that till this time period, the name of the company is Fortune India Limited and it have both the divisions. Yes, Naveen, thank you. That is Competition Act 2002 and Competition Commission of India, right? In that act, there is an authority called Competition Commission. Yeah, that is called as Competition Act only. Thanks, Naveen. This is related to the previous query of Namita, in which I was trying to answer the customers whether it is beneficial or not. Okay. Now, for 1/4/2009, it is the opening balances here, and 31st of March 2009, it is the closing balances here. So what I'm trying to say is that up till 31st of March 2009, the close of business, they are running with a company named as Fortune India Limited with a consolidated business. This is Fortune India Limited with a consolidated business. Correct? And this is Fortune Pharma. This is number one company, and second is the Fortune India itself will continue with the FMCG group. Correct? This consolidated business for pharma and FMCG. But now, as on opening of the business of 1/4/2009, they have demerged 1 and 2. Okay. And before the demerger, they are saying that they are having a 3,000 lakhs equity share of rupee 1 each. Details of Fortune India Limited is this much and Fortune Pharma Limited. So they have given the opening balance sheet of the new entity and the closing balance sheet of the total entity as follows. Correct. This is the new entity and this is the closing of old entity. Old entity is still continuing, but I'm saying before demerger. Okay. So they have given us some liabilities, some of the assets. These are some of the extracts only. These are not the exact share capital that they have given. Now, board of directors of the company have decided to issue necessary equity shares of Fortune Pharma. Now, see, students, we already have a company. This is Fortune India. Now, from this, we are actually demerging some of the business operations. Let's say this is pharma, correct? Now, pharma is getting demerged. Earlier, the shareholder of Fortune India will enjoy the total value of India put together, which is FMCG plus pharma, correct? It would have been enjoying the total value, but now since pharma is moved out, so don't you think that the total value of Fortune India will come down from the shareholders' perspective, correct? Hence, to compensate that, in the new company also, Fortune Pharma also, the shares will be issued to the existing shareholders only to compensate for that reduction. Correct, because the business has moved out. To protect that, the existing shareholders will get shares in the new company also. Correct. This is what the question is trying to say. So the board of directors of the company have decided to issue necessary equity shares. Necessary is the word to be emphasized because that is what we are trying to calculate, of Fortune Pharma Limited of rupee 1 each, without any consideration to the shareholders of Fortune India Limited. So they are saying that from the shareholders of Fortune India Limited, they are not going to take any consideration. They are just going to issue the necessary equity shares of the new company called Fortune Pharma Limited. Why they are not taking any consideration? Because already they have invested in Fortune Pharma Limited, which was running at that point of time with two businesses. Now, if we are separating the businesses, it has nothing to do with shareholders for them to contribute more, because they have already contributed to run the two businesses. Now, if we are forming a new company, ideally the new company shares also to be issued to the shareholders of the Fortune India Limited without any consideration. I hope this demerger part is very clear. Correct. Now, for that purposes, following points are to be considered. Now, the transfer of liabilities and assets will happen at book value. Okay. Estimated profits for the year is, for the next year after this demerger, they are saying it will happen as 11,400 for the FMCG business and 1470 for the pharma business. Okay. Because now in Fortune India Limited, only FMCG business will be there. Estimated market price of Fortune Pharma is 24.50 per share. They are saying that Fortune Pharma, the new company formed, for that they had done a valuation, and basis that valuation, they are able to understand that it is 24.50 per share. Average PE ratio of FMCG sector is 42 and pharma sector is 25. They have given us the PE ratio as well of both the types of businesses. That also we will be able to use, which is expected for both the companies. They are saying that for the industry is this much, and the same you can apply for the companies as well. Now, the next part, they're asking us to calculate the ratio in which the shares of Fortune Pharma are to be issued to the shareholders of Fortune India Limited. Now they are saying that what is the ratio in which they are going to issue the shares of Fortune Pharma to the shareholders of the Fortune India Limited. Okay, students. Now, if you see, how can we calculate the number of shares? First of all, see, our approach in this is very simple. We know that Fortune India already have 3,000 lakhs equity shares that are there. Correct. So we know that there are already 3,000 lakhs equity share that is there in Fortune India. Now, what should be the number of shares for Fortune Pharma? Now, students, if you see, we are given PE ratio and market price per share. Can we calculate using that what is the EPS expected? Correct. And EPS is equal to earnings divided by number of shares. Correct. We are also given PAT for the earnings. EPS we will calculate from here. Earnings we are already given. We will be able to come to the number of shares based on this formula. Correct. Sorry. So that means those number of shares will be issued to these 3,000 lakhs number of equity shareholders in Fortune India. Okay. Now let us calculate. First of all, the PE ratio is given as how much? 25. estimated earnings per share. We are also given market price per share as 24.50. Correct? So the estimated earnings per share will be 24.50 divided by 25. Namita, please complete your question because you have asked. The incomplete question has come to me. You mentioned only sir shareholders of Fortune India. Please complete that question. 24.5 divided by 25. So MPS divided by the PE ratio gives you the estimated earnings per share. Correct? That comes out to be 0.98. Now we have come to know that what is the estimated earnings per share, what is the profits that are given in the question for the new company is 1470 lakhs. 1470 lakhs. These are the profits. That means the number of shares can be calculated as 1470 lakhs divided by 0.98. Correct, students? It comes as 1500 lakhs. So 1500 lakhs are the total number of. No, Namita, your question has not reached to me fully. I'm still yet to get it. No, please send me again, Namita, because it only says sir shareholders of Fortune India. Okay, so the number of shares, it says that 1470 lakhs divided by 0.98 is actually 1500 lakhs. Correct? That means the swap ratio, or not the swap ratio would not be the right word, but the ratio in which, because the question one was what? The ratio in which the shares are to be issued. Correct? So the ratio becomes 1500 divided by 3000 lakhs. Correct? Because 3000 are the existing number of shares for Fortune India Limited. Correct, student? So it is 1500 divided by 3000. Okay. That means 0.5 for one share. This is what we can write. This is the ratio. Hence, the ratio is 0.5 share of. Actually, we should write here as 2 shares of Fortune Pharma for 1 share of Fortune India. Correct? Now, let us go to the next part. The ratio is done. Expected market price of Fortune India, which is the FMCG company. So they are saying that what is the expected market price of the new company. So students, we have the PE ratio. Can we calculate the EPS? Yes. Using that, can we calculate the market price? Yes. This is very easy. So the second part, expected market price of Fortune India, which is FMCG. Correct. So this is going to be estimated profits. We are given in the question as 11,400, correct? And the number of shares. Students, here comes the catch. Now, there is a question to all of you. Tell me, what should I write here in terms of number of shares? Shall I write 3,000 or shall I write 3,000 plus 1,500? Option 1 or option 2? Just put your answer whether I should write option 1, which is 3,000, or option 2, which is 4,500. What we have to calculate is for Fortune India, which is the FMCG company that is left, what are the number of shares? Estimated profits is 11,400. Don't forget that Fortune Pharma have issued 1,500 shares to the equity shareholders of Fortune India Limited. Don't forget that, correct? Bearing that in mind, tell me whether I should put 3,000 or 4,500. I request all of you to please attempt this part. Just type option 1 or option 2 on the query handle. Naveen is saying A, perfect. Vidula Yogesh Deshpande, yes, you're right, 3,000. So Namita, okay, I'll tell you why we are not taking 4,500. See, again, I'm just repeating. This is as of now one company, correct? This is one company having two businesses. One is this pharma, sorry, one is this, I can say FMCG, because FMCG is a big business, hence big box for FMCG, and smaller box for pharma, because pharma is a smaller business, correct? As of now, it is one company, and one company have 3,000 equity shares issued, correct? Now, we have just moved these 3,000, we have just moved this pharma segment to the new company. Still, the number remains same. In the existing company, the number remains same. Now, this pharma, now see how the split has happened. This is FMCG. This is pharma, correct? Now, there are two companies. Let's say this is India Limited. Again, I'm saying Fortune India Limited and Fortune Pharma Limited, correct? Now, FMCG still have 3,000 equity shares only, and this is held by shareholders, correct? 3,000 equity shares issued by the company and held by the shareholders. But pharma company issues 1,500 shares not to this company, but to the shareholders, right? They are issuing it to the shareholders. So for shareholders, the total holding becomes 4,500. But for this FMCG company, still the issued shares is 3,000 only. Correct? So hence, we will take option 1 here, which is 3,000. This is wrong. Option 2, we are not going to take. Because the shares are issued by a separate company and are issued to the shareholders. So Fortune India has nothing to do with it. Fortune India, which is the FMCG company, still it has issued the same number of equity share, that is 3,000 only, to the shareholders. Its issued capital is not going to increase, correct? So hence the estimated EPS comes out to 3.8. Okay. Estimated EPS comes out to 3.8. Then the estimated PE is already given in the question is 42. Can we calculate what is the market price? MPS 3.8 multiplied by 42 is equal to 159.60. Okay, students. So this is the MPS part of the solution. Now the next part. Expected market price, and yeah. Now the book value per share of both the companies immediately after the demerger. Now students, here is the catch. They are saying that what is the book value of both the different companies. Here we are given the total book value before demerger and the book value of the new company formed. We are not given the book value of the company that is remaining after demerger. So that we will have to calculate. See how we are going to calculate that now. Now the third part. Book value. So first of all, I am putting the Fortune India. This is before demerger. Correct? Then I am putting Fortune Pharma. Fortune India I have put, Fortune Pharma I have put, then Fortune FMCG, which is still India only, but this is after demerger. This is also after demerger. Correct? So this is still Fortune India, but the FMCG business. This is what we are trying to indicate. So let's put the data that is given in the question. If we total all these assets, correct? Fixed assets, investments, current assets, loans and advances, and deferred tax or miscellaneous expenses. If we add all of them, the total comes out to be 70,000. That means the consolidated business have a total asset base of 70,000 lakhs. This is in lakhs only, no? Total. Yes. Liabilities. Similarly, we will do the total of liabilities. We will arrive at 25,000 lakhs. So the book value is your assets minus liabilities, correct? Which is 70 minus 25,000. 70,000 minus 25,000 comes as 45,000 lakhs. So before demerger, the net book value was 45,000 lakhs for the Fortune India Limited, with an asset base of 70,000 lakhs and the liabilities to be paid is 25,000 lakhs. Now, after the demerger, the Fortune Pharma that is created, the assets has been transferred to the book value and the liabilities are also transferred at the book value. So what is the total of those assets and liabilities after demerger? Is this. Let's total this. The total of this is 25,100. And the liabilities is 4,100 lakhs. So that means the total is 21,000 lakhs. This is Fortune Pharma. So 25,100 and 4,100 comes as 21,000 lakhs. Now, after demerger for Fortune India, whatever will be left is the difference between these two, right? Because before demerger, if Fortune India was holding 70,000 assets, Now 25,100 is transferred to the pharma. What will be left here? Sorry. So what is left here is 44,900 lakhs. Similarly, liabilities also 25,000 is the total liabilities. 4,100 is transferred to the Fortune Pharma. That pertains to Fortune Pharma. What is left is 20,900 for Fortune India. And hence, the net worth of Fortune India, which is the FMCG business, is 24,000 lakhs. And please note the number of equity shares. If I have to put number of equity shares is 3,000 here, 1,500 here, and 3,000 here. Correct? So 3,000 lakhs here, 1,500 there, and 3,000 lakhs there. Hence, the net worth is already we have calculated. So the book value per share, 45,000 by 3,000, 50, 15, 21,000 divided by 1,500, 14, 3,000 divided, sorry, 24,000 divided by 3,000, which is 8. So the book value per share is 14 and 8 for the new companies that are formed. This is what the question was asking us to calculate. So for the new companies that are formed, which is Fortune Pharma, the book value per share is 14%, 14 rupees, and the Fortune India after demerger, whatever is the left value is 8 rupees per share. Okay, students, I hope this part is clear. I will just give you 1 minute to write down all this. Then we will move to the next question. Question number 16, students. Again, a very beautiful question and very logical question and very practical also. Question number 16 says that H Limited agrees to buy over the business of B Limited effective 1st of April 2012. Okay. So there are two companies, H Limited and B Limited. H Limited is agreeing to buy the business of B Limited. Okay. So students, the issue with these questions is that these questions have a lot of information, correct? So try to register these numbers or try to register these facts in your mind as and when you read it, correct? And try to form that picture in your mind, correct? The broad picture in your mind. Obviously, don't remember these things, the values that are given, but like this balance sheet and all, because that you can always refer, but at least try to create some kind of a picture so that you know that how the question is structured and how what is the flow or from where we have to start and where we have to end, correct? Now, they have also given us the balance sheets as on 31st of March 2012. That means very similar date, because whenever we talk about 31st March, that is always the close of business. Whenever we talk about 1st of April, that means that is the opening of the business. Correct. So the same point of time, they have given us the balance sheets as well, in which they have given us the paid up share capital. Now, if you observe here, there are two different kinds of paid up share capital. No, they're not two different kinds. For the different companies, it is different. It is 100 rupees each share and it is 10 rupees each share. Correct? For B Limited, it is 10 rupees paid up share capital. For H Limited, it is 100 rupees paid up share capital. Reserves and surplus are given. Then we are given the assets. Now, H Limited proposes to buy out B Limited, and the following information is provided to you as part of the scheme of buying. So they are saying that following is the information that is additionally given to you. Now, what is that information? Number one, the weighted average post-tax maintainable profits. Now, see, students, the weighted average post-tax maintainable profits of H and B for the last 4 years are 3,000 crores and 10 crores respectively. Don't get confused by this big term. This is just they are trying to say that in future we expect that the best possible profit for H and B Limited for the years to come is 300 crores and 10 crores per year respectively. Okay, that's all. Both the companies envisage a capitalization rate of 8%. Now, how does this capitalization will help us? So students, this is a very simple principle of valuation. What is that? If you have dividend, or I am saying, let's say if you have a return, any kind of return, whether it is dividend, whether it is interest, whether it is anything, whether it is profits, and that from that return you have to calculate the value of the investment. I'm saying value of the investment. Correct. So how you are going to do? You need a percentage there. Correct. The percentage of return. So the percentage return is actually absolute return divided by the value of investment. This I am saying this is ABS. ABS means absolute. Okay. Return absolute divided by the value of investment. Can I switch this? So the value of investment is equal to return absolute divided by the percentage return. If you do this, you will get that what is the value of investment. Correct. Similarly, if I can say that rather than looking this equation as an investment, if you want to look this equation for valuing something, let's say if I want to value a business, I know that what are the returns in future going to be in absolute, and I know that what is the percentage expectation of return. Can't I value the business today? Yes, we can value the business today. I'm saying instead of valuing the investment, you see all of this as valuing the business. Hence, if they have given us the future profits and a capitalization rate, can we calculate the valuation of business? Yes. Using this, we can calculate 300 crores divided by 8%. Simple. Okay. Now, the next point, H Limited has a contingent liability of 300 crores as on 31st of March 2012. So, in the footnote to this balance sheet, it is mentioned that there is a contingent liability of how much? 300 crores. Although it is not part of the balance, I mean, not coming into the balances, it is separately shown as a footnote. Sorry. That means this amount is not accounted for yet. Now, next part, H Limited to issue shares of rupees 100 each to the shareholders of B Limited in terms of the exchange ratio. Now, H Limited will, since the registered share capital is 100 only, they will be issue 100 rupees. Sorry, just a second. 100 rupees shares only. Sorry. So they are saying that the shares will be issued basis the exchange ratio that has to be arrived on a fair value basis. Now, what is that fair value basis? They are saying that please consider weights of 1 and 3 for the value of shares arrived on net assets basis and earnings capitalization method. So they are saying you follow two methods, NAV and earnings capitalization method. Put this as a weight of 1 and this as a weight of 3, arrive at the total fair value deal. What would be the fair value? NAV is simply the net assets value, total net assets divided by the number of shares, correct? Now, you are required to arrive at the value of the shares of both H Limited and B Limited under NAV and earnings capitalization method. So they are saying first you calculate the value of shares of both the different companies differently under NAV method and earnings capitalization method. And lastly, you also do one thing, exchange ratio of H Limited of H Limited of shares of H Limited to be issued to the shareholders of B Limited on fair value basis, which is nothing but this after taking the weights of 1 and 3. This is what we have discussed in the point 4 above. Correct? Simple. I think the question is simple. Now, what has to be done with this contingent liability? Now, students, if you see, although there is in NAV, this contingent liability is not accounted for. So we should account it for because the question has given us this information and we will assume that the contingent liability will become crystallized and it is payable in full. Correct? So we will take that part of the assumption here and then do the calculation. Contingent liability to be payable in full. Simple. We will assume that it is payable in full. Now, there is a net assets value, correct, for H Limited. This is how much? Total assets minus total liabilities. So 1300 minus, yeah, that's all. The liabilities are already adjusted because these are net fixed assets and net current liabilities, correct? So those are already adjusted. 1300 minus 300 for the contingent liabilities divided by number of shares. The number of shares is how much? 350 divided by 100, which is 3.5. Correct? This is for contingent liability. This is equal to 1000 divided by 3.5. 285.71 per share. This is for H Limited. Similarly, for B Limited. B Limited, what's the total assets value? 31.5. And the number of shares are 6.5 divided by 10, which is 0.65 lakhs. Sorry, this is in crores. So 0.65 crores. Correct? B Limited, 31.50 divided by 0.65. Both of them in crores. That means the book value comes as 48.46 per share. This is for B Limited. Now we have calculated both for H Limited and B Limited what is their respective net assets value. This is very simple. We have just taken the data from the given in the question and done this. Now coming to the earnings capitalization method. Now students, if you see the earnings capitalization method is here not at all complicated. Now, what would have been those complications? The complications would have been if the earnings capitalization method, the earnings would also be growing at the same rate. Then you would have to apply the same growth formula that we have taken earlier. Correct? In the one of the question earlier, we have used the growth to arrive at the terminal value, right? So that same formula we would have applied. But here, since there is no growth that is happening in the earnings are same, we can easily apply the formula that I have discussed just now above for the investment purposes. This one, correct? So the earnings capitalization method is how much? 300 crores is the earnings for H Limited per annum, and 8% is the capitalization rate. It comes as 3750. Now, per share value is how much? 3750 crore divided by 3.5 crores. Because 3.5 crore is the number of shares. 3750 divided by 3.5. 1071.43 per share. This is the earnings capitalization for H Limited. Then for B Limited, similarly, the profits expected in future is how much? 10 crores. Divided by 8%, correct? Which is equal to 10 divided by 8% again, which is 125. 125 crore is the total valuation of the company. So the per share valuation will be 125 crores divided by 0.65 crore. Correct? So this gives 125 divided by 0.65. 192.31 per share. So both for D Limited and H Limited, we have calculated the per share value both in net assets method as well as earnings capitalization method. That is what the first part of that is what the first and second part of the question was. Namita is asking, sir, in previous question, per share value is not asked provided number of shares. Okay. So Namita, why we have divided with the number of shares in FMCG? Let us read out what exactly it is asking us. No, Namita, it is asking us to calculate the book value per share. Okay, are you referring to this question only? Okay, this question also. Okay, I got it. I think you're referring to this question. Yeah. So, Namita, yes, you are right. In this question, it is not asked, but we have calculated it because in the next part, we have to calculate the exchange ratio. Okay. For calculating the exchange ratio, we would need the per share value. Okay, Namita, I think that was a good question, Namita. But see, the question is asking us to arrive at the value of the shares. Now, see, this can be interpreted that it is asking us to calculate the value of one share, and even it is asking us to calculate the value of the total shares. Value of the total shares means value of the company itself, and value of one share means the number of, dividing it by the number of shares. Okay, Namita. And anyways, we will be using the per share value in the exchange ratio. Okay. Now, coming to the third part, swap ratio For that, first of all, we have to calculate the fair value. Now, fair value is as per the question, right? Not as per the concepts. The question is saying you attach one weight to NAV method and 3 times of the same weight to earnings capitalization method, and then you arrive. So the fair value of H limited is how much? Now we will make use of the per share value 285.71 into 1 plus earnings capitalization method is how much? 1071.43 into 3 whole divided by 4. This will give us the weighted H limited's value. Correct. So this comes as how much? 875. This is for H limited. Similarly, for B limited, the fair value will be 48.46. The NAV method is 48.46 per share into 1 plus. It is 192.31 into 3, which is the earnings capitalization model. This comes as 156 point. This coming as 156.3475. Correct. Now we have calculated the fair value of both H limited and B limited. These are the fair values. Using this, we will have to calculate the swap ratio. Is it 875 or 857? It is 285.71, 1071.43 multiplied by 3 divided by 4. It is 875. Correct. So this will give us 156.3475 divided by 875. 0.1787. This is the swap ratio as per the question. Okay, students. This is the swap ratio that is asked in the question to be calculated. I think very easy and very simple. Any other doubts? Namita, your full query has not reached to me still. If you want to ask that, please again resend the query, the earlier one. And yeah, let us go to the next question, question number 17. I think you guys just note it down. Today in the class or in the session, we have mostly covered all the questions only, because more and more questions you do it, better you are prepared. And also students, now while you want to revise this, correct, I would suggest that at least in the next revision, you should again go through all the questions and make for your specifically notes that in this question, this thing was the main point where you have done kind of a mistake, or you think that this needs to be revised. Correct. Because ultimately, in the last revision, you will not be able to solve all these questions. And this is true for all the topics. At least one or two revision, you should do 100% questions. I am saying in the revision also. But after that, you should mark some of the critical points in that question, or what is the catch point in that question, or where did you mistake, or where had you done the mistake in that question. Just keep on writing it on one page, so that in the last revision, you will go through those specific pointers to see that, okay, this is what it is. Okay, now Namita is saying, sir, if in calculation of number of shares to be issued to be limited, if we get figure in decimal, then ideally what to do? Okay, you leave that in decimal. See, here also, I have left it in the decimal only, right? The exchange ratio. Because they're asking us to calculate the exchange ratio. And if they're asking us to calculate the number of shares, then you round it up to the lowest level or to the highest level, whichever way it is okay. Okay, but don't leave it into the fraction. One share here and there is okay. I mean, the points shares of plus and minus is still okay. Correct. But the number of shares, don't leave it in fraction then. Now let's go to the next part. Question number 17. Now this is also a very good question. Okay, now a good question from Naveen. Before we go to the question number 17, I'm reading out his question. So he's asking, sir, in case of demergers, will the shares of resulting company be issued directly to the original shareholder or to the demerged company? It so basically, if you see Naveen, the last to last question of Fortune Pharma and Fortune India that we have done, in that it was specifically mentioned that it will be issued to the shareholders of the company. See, in this they have clearly said, decided to issue necessary equity shares without consideration to the shareholders of the Fortune India Limited. See, they are saying that the shares will be issued directly to the shareholders. And in demerger also, that shares are issued to the shareholders only. But practically, there can be situations that where the scheme of demerger says that it will be issued to the company also. Okay, so it is not a thumb rule, but mostly the situation will be made clear in the question or in the facts, or else we will assume that it is issued to the shareholders only, because generally the shares in case of a merger and demerger, both the cases are issued to the shareholders, not to the companies. Okay, Naveen? Because in merger also we said na, that the new entity will issue the shares to the dissolving entity's shareholders, not to the dissolving entity itself. Correct. Now coming to question number 17, AFC wishes to acquire BCD Limited. There are two companies, AFC and BCD. The shares issued by the two companies are 10 lakh and 5 lakh respectively. This is the total number of shares that they have issued. Now, first of all, students, if you see for any company, correct, let's say this is BCD. If you see their valuation chart will be like this. Why it is moving up here? Because here the news come that there is a merger happening of BCD merging into AFC, correct? So BCD is merging into AFC. That news has come and hence the valuation has gone up. Now this is the exact date of valuation. Sorry, this is the exact date of merger. So it will go up like this, correct? Now, keeping the same thing in mind, question is saying that calculate the increase in the total value of BCD Limited resulting from the acquisition on the basis of the following conditions. Although once it is acquired, although once it is acquired, still they're asking us to calculate that once the information goes out in the public, it will result into the higher value of BCD Limited. They're asking us to calculate that. Correct. Although BCD Limited, once it is acquired, it has to be dissolved. There is no value, but still they are asking that before dissolution and before merger, there is a news that has come and basis that what is the revised increase in the total value of the BCD. Correct. So basically, they are saying that here there is some value, and here there is some value. What is this is value 1, value 2. What is the difference between value 2 minus value 1? This is what they're asking us to calculate. Simple. Correct. So they are saying that the current expected growth rate. Now we will dissect all the information into two parts. One is, this is before announcement. And this all is after announcement. Announcement of what? Announcement of merger. Correct. This is all before announcement. This is all after announcement. Now, the merger will happen somewhere here. Correct. After announcement only the merger will happen. Now we have not gone till the merger also now. So what they're saying is current expected growth rate is 7%. So before merger, it is 7% growth rate. After merger, once it happens, without additional capital investment, the expected growth rate continues to be 8%. So this period, it is going to be 8%. So see the change. Okay. So there is a change from 7% to 8% on the expectation. The current market price of AFC is given as 100, BCD is given as 20. The current market price is given as 20. We have to calculate the market price after announcement. Let's say it is coming out to be 25. So this is the change, right? 25 minus 25, 5 rupees per share is the change, is what the question is asking us. We will multiply it with the total number of shares, correct? And expected dividend is 0.60. That is also given to us. Now, students, please see. We will use the dividend model to value the equity share. We are given that 0.60 per share is the dividend. Correct? Growth rate also we are given. Growth rate is 7%, two different growth rates, and 8% under two different scenarios. 7% standalone, 8% once it gets merged. So can we say that market price? First of all, we know that market price is what? Market price is equal to dividend divided by cost of equity, which is KE minus growth rate. This is what we do, correct? As per the valuation model, you would have studied already. Cost of capital, I'm saying here, correct? Cost of capital minus growth rate. So what is the current market price? Current market price is 20 rupees. What is the current dividend? 0.60. What is the current cost of equity? That we don't know. What is the current growth rate? That we know, 7%. So I am just putting all of this, the current values. That means before the announcement of merger. So from here, if we solve, KE comes as 10%. Cost of equity comes as 10%. So 0.6 divided by 20 plus 7 comes as 10%. 0.6 divided by 20 plus 0.07 is 10%. Correct. So cost of equity is 10%. Now we have to replace all this information for the new after the announcement. Correct. After announcement, market price is what we have to calculate. Dividend is still remaining the same only, because dividend there is no change. Cost of equity becomes 10% and the growth rate becomes 8%. Cost of equity we just now calculated, and growth rate becomes 8%. This is after announcement. After announcement, MPS will become now how much? If you see, the MPS will become 30 rupees. So can you see the difference? So current valuation, is 20 into 5 lakhs number of shares, which becomes how much? 10 million, correct? Revised valuation is how much? 30 into 5 lakh, which becomes 15 million. $1.5 crore and 1 crore. So that means the increase in value that has happened is 5 crores. Sorry, 50 lakhs. Yes. From 1.5 crore to 1 crore. From 1 crore to 1.5 crore, it is 50 lakhs. Correct? This is the increase in value. Now, Naveen is asking when it's issued to the company, net assets will not change much. Yes, Naveen, the net assets will never change until unless the takeover is happening at some other values other than the book value. Correct? So the net assets will not change. Namita is saying, sir, in question number 15, line starting with board of directors gives a message that shareholders of Fortune India. Namita, I've got your query till now here only. I mean, till here only. Maybe I've not got your full query, Namita. Again, there is a issue. Okay, so this is done. Now let's go to the second part. On the basis of aforesaid conditions, calculate the gain or loss to the shareholders of both the companies if AFC Limited were to offer one of its shares for every 4 shares held for BCD. 1:4 is the holding, correct? 1:4 is the exchange ratio. So second part. First of all, this also I will break into 2 parts. One is immediately before announcement. So basically before merger, I am saying now, before merger, not before announcement, but before merger. What is the market price of AFC Limited? It's 100 rupees, correct? That is given to us. Less 4 shares of BCD will be taken here, correct? 4 into 20, because 1:4 is the ratio. So that means the current person who is holding 4 shares of BCD, that is the equivalent of 80 rupees, he will get 100 rupees in return after the merger. So that means there is a gain to him of 20 rupees. Gain to the shareholder of BCD Limited before merger announcement. This is actually announcement only. Okay. Before the information comes that it is going. And B part. So this is A part. B part, I'm going to calculate after merger announcement. Actually, students, if you see, in the first part, since we are given 2 different values, hence I am putting it before merger announcement and after merger announcement, because it is 20 rupees and 30 rupees then, correct? So now coming to, first of all, AFC Limited. If we talk about AFC Limited, so AFC Limited, what is the value of company? First of all, we will see for AFC. AFC is how much? 10 lakh shares into 100 rupees price. Correct? So I'm just putting here numbers in rupees and lakhs. Correct? So it becomes 1000. And similarly, the BCD value is 5 lakh shares multiplied by 30 rupees. Because after merger, the value will become 30 rupees, right? 5 lakh shares into 30 rupees. This is BCD. That means 150 more here. Total is 1150. So that total merged entity value is how much? 1150. Now we have to calculate that what is the proportion of AFC Limited shareholders in the new entity and the BCD Limited shareholders in the new entity. Value per share. So see students, 10 lakhs was the initial shares plus on 5 lakhs. They have issued 1/4, correct? These are the total number of shares. So let me write here, number of shares. This comes as how much? 11.25 lakhs, correct? Hence the value per share is 1150 lakhs divided by 11.25 lakhs, which is equal to 102.22 per share. So students, if you see the value per share becomes as 102.22 per share. The AFC Limited's value before merger was 100 rupees. Now, after merging BCD Limited, it has become 102.22. So, what is the gain to the AFC Limited shareholders? It is 102.22 minus 100 rupees, which is 2.22 per share. This is the gain to the AFC Limited. And to the BCD Limited's shareholders, what is the gain? So 102.22 minus 80 rupees, which comes as 22.22 per 4 shares of BCD Limited. Correct? So one share value is 102.22, but that is exchanged for 4 shares of BCD, which is 80 rupees. Correct? And hence there is a 22.22 rupees gain, but on 4 shares of BCD Limited. Yes, Namita, you can send it through email. Now the last part. This is done. Last part says, calculate the gain to the shareholders of both the companies. Again, now they are giving us a new situation. In case AFC Limited pays 22 rupees for each share of BCD Limited. What is the current value of BCD? 20 rupees. AFC says that, okay, let's do the deal. I will pay you 22 rupees per share that you have to BCD Limited. And they say that the PE ratio of AFC Limited does not change after the merger. EPS of AFC is 8 and BCD is 2.5. And they are saying it is assumed that AFC invests its cash at 10%. Now see students, what we will have to do is, third part is totally a separate part. They are saying pay in cash, then calculate EPS and PE ratio existing one. Using this, you derive the MPS and then you tell us what is the gain or loss. Correct? Simple. So first of all, the PE ratio of AFC Limited is how much? 100 divided by 8. Correct? 100 is the market price, 8 is the EPS that is given, so which becomes 12.5. Post merger earnings will be how much? We are given the EPS, so 10 lakhs multiplied by 8 plus 5 lakhs multiplied by 2.5, which becomes 92 lakh 50,000. Correct? The post merger earnings is 92 lakh 50,000, but in this we will have to reduce the cash payment opportunity cost. This needs to be reduced. Why? Because we are making a cash payment of 22 rupees on 5 lakh shares, and on that we would have earned easily 10%. Correct? See this one, 10%. Correct? Sorry. So hence this amount has to be reduced. 22 rupees on 5 lakh shares at the rate of 10%. There is a 11 lakh rupees reduction that will happen in the total earnings going forward. Going forward, the total earnings will be 90 to 50. From that, since we are paying this much of cash, we will lose this much of investment opportunity, the return opportunity, and hence it will come as 81 lakh 50,000. Number of shares will remain 10 lakhs only. If we talk about after the merging, hence the EPS per share will be 8.15 per share. PE ratio we have already calculated is how much? 12 and a half. So MPS for AFC Limited will be 12 and a half into 8.15, which is equal to 101.875. Correct? It is going to be 101.875. This is the MPS. Now gain to AFC Limited shareholders. It is going to be 101.875 minus 100 rupees, right? Which is 1.875. Now, students, this is the last part that I want to ask all of you in the today's session. What is the gain to BCD Limited? Shareholders. Do anyone want to attempt this? Please send in your responses. What do you think will be the gain to the shareholders in the last part of BCD Limited? AFC is very simple because AFC, the company is continuing. We have calculated the new EPS, the PE ratio, the new MPS. Using the new MPS, we have compared the existing price and we have worked out that what is the net benefit. But BCD, what do you feel? What are the BCD Limited shareholders are going to get after this? I will wait for all of you to attempt this. See, student, while seeing this, you just remember one thing in your mind. What is the BCD shareholders are getting? See, while you have to calculate the gain from AFC standpoint, you will see that what currently AFC value is and what they will get after merger. Similarly, what BCD Limited shareholders value is currently and what they are going to get. Get minus what they have currently. It is very easy in case of cash payment. It is very easy in case of cash payment, I'm saying, and it is very straightforward also. I will write it. They are going to get 22 rupees. They are already having a share price of 20 rupees. That means 2 per share of BCD Limited will be the gain to them. Simple. They will earn a gain of 2 per share of BCD Limited. No, Namita. As I explained now, they will get cash, right? Since they don't have any shares, but they will still get cash. So they are getting 22 rupees of cash. They are having a value of 20 rupees. Hence, 2 rupees will be the gain to them. But this 2 rupees per share of BCD Limited. Huh? Similarly, in this, I again clarified this 22.24 is for 4 shares of BCD, right? Not for 1 share of BCD because there is an exchange ratio of 4 shares, correct? This is what I'm trying to say. Here, and in that, they will get 2 rupees per share of BCD Limited as gain. Okay, students, now with this, we have completed the today's session. We will attempt some of the questions and some of the theoretical part in the next session. and we will wrap up the mergers and acquisitions. Till then, please do revise well over the weekend, and all the best for your preparations. We'll meet in the next session. Yeah, thank you so much. Have a good day ahead.